would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Thank you so much for taking the time to join in with me on today's show. We've got a great tool that I think you're all going to enjoy taking some time looking at. We'll get to that in a minute. Best way to reach out is to head on over to the website at therebelbroker.com. From there, you can send me a message, or you can put your hat in the ring to win yourself a $50 Amazon gift card. It's just so easy to do. Click the red button at the top titled Take the Survey to support the show. Once you're there, use the same email address both times you're asked, answer a handful of questions, and you're helping the show by giving a little bit of audience information. Plus, you're getting yourself in the running for a $50 Amazon gift card. We've already given away $200 worth of gift cards to 4 different folks. And we'll be doing that again, well, within the next week, right? With February right around the corner. Well, right here, we're there. Today's February 1st. We'll be doing a drawing here in one of the shows coming up here over the next few days, and we'll get ourselves another winner. I'll definitely not do it till at least the weekend, so you've absolutely got time to get in before the next drawing. Again, you can head on over to therebelbroker.com, click that little red button at the top of the page, and you'll be ready to go. Also, I am happy to report that after a couple of false starts and ultimately maybe going a little bit longer than you would normally go for a typically successful YouTube video, but you know what? It's really more about just getting you the information. The video is up and ready for the folks in the Rebel Underground to take a look at how I go through my process of figuring out where I want to search in a metro community. We assume step one, you've picked a place. Then we take it to the next steps of what tools I use to analyze that stuff. The next step will be to actually get into the nitty gritty of analyzing a specific property. If I had included that into this video, it would have been an hour video, and nobody needs that. So if you are interested in being able to view that, you'll need to be a member of the Rebel Underground. In order to do that, you need to text the word Rebel Broker, the number 44222. That's text the word Rebel Broker to the number 44222, and then you will be given a link to access that video. Now, for those of you who are already in the Rebel Underground, you'll be receiving an email soon. It has not been sent as of the creation of this show. I am in the process of uploading the finished video so that everyone can access it. And then once that is done, the very next thing I will do will be to send out the link for that video to everyone on the mail list. So don't panic. You will get it. If you've already registered for the Rebel Underground, you will get it. And if you register for the Rebel Underground after I send out that email, part of your welcome to the Rebel Underground message will include a link to that. So don't worry that if you miss the email, you miss the opportunity to get at that video. There are a couple of interesting things to note. You know, we all talk, there's often milestones in the real estate business, right? Just like there is in the stock market, going over 20,000 or, things that are major milestones that folks tend to focus on. Well, we've hit one in real estate. According to the folks at Case Shiller, the housing market now officially has completely recovered, meaning that just about everywhere, prices are now back where they were at the peak or higher. Some areas obviously are higher. The folks over at Housing Wire, I'm going to go ahead and include in my Pinterest page a shot of this particular graphic relating to what the prices are, which is kind of interesting. And this is actually based more on a composite. So according to the latest data released Tuesday by S&P, Dow Jones Indices, and CoreLogic, the S&P CoreLogic Case Shiller U.S. National Home Price NSA Index, which covers all 9 U.S. Census divisions, increased 5.6 annually, up from 5.5 from the previous month. The 10-city composite increased by 4.5 from November 2015, up from 4.3 in October. Similarly, the 20-city composite increased 5.3 year over year, up from 5.1 the month before. So given all of that, we've now gotten to the point where we have sort of caught up with that old position. And I've said this before, but it's not a milestone, I think, necessarily to celebrate. Now, we can talk about the markets and we can make the argument that, well, now we're back where we were then in most markets, or better than we were back then. And now it's more okay because if we had more of a natural curve to the increase in property values, it would have made sense for us to be at this price point this much later on. So if we had just had a much more mild or much more normal curve to this point, it would have been healthier, right? If we had just managed to get to omit that crazy bulge there in 2006, 2007. Well, I'm not 100% sure that's true. If you actually sort of plot out the average increases going back decades, if you try to look for a more decade normalized trend, we're still a little bit higher than we should be, which I think is a little bit of a concern. And it just reminds us of a point in time when things were very bad or about to get very bad. I frankly don't want, and the other thing is that we need to understand that wasn't a single little isolated moment in time. It didn't just come out of the blue. It wasn't an asteroid falling out of the sky. It wasn't a flash flood. It was a event that could be traced back to actions that have been going on for 10 to 15 years prior to it actually happening. And what's concerning is, as we've talked about on this show, there's an awful lot of things going on that indicate we haven't really learned the lesson. We still seem focused on, I don't know how to describe it. I guess it's a feel-good thing. And for me, I always come down on, you shouldn't feel good about putting people in a really bad situation. And I get, because that seems to be what everyone waves the flag on, right? Everyone seems to want to celebrate because everybody was doing it. Everybody in Congress, everybody in the White House, when we had 68% home ownership, everybody wanted to really go out there and wave the happy times flag without realizing that everyone had been saddled with an awful lot of debt on a foundation that was manufactured. It wasn't something that was a natural market thing that did it. It was fooling with market elements that got it to that point. And we're doing that kind of stuff again. We've talked about it here, whether you want to talk about fooling with qualifying for a loan. Last time we did it, we simply said, even though you're very low in terms of qualifications, even though you are a subprime borrower, we will go ahead and loan to you. Now we're approaching it from the other side, where we're screwing with how that credit rating gets calculated so that folks who would normally be considered much more subprime borrowers will qualify because we've sort of fixed the numbers to make it look like they're better borrowers than they are. And again, we've gone through all that. You can go through any one of the shows over the past couple of months and get a little bit more insight into the discussions we've had on that. But I think this is a major thing to keep in mind. And of course, I will absolutely have a link to the articles relating to this in the show notes for today's show. I'm trying to see if there was any other really big revelation in any of this. There's nothing else really with that I think is worth noting. But another thing to sort of add to this, I think, is consumer confidence. With prices where they are, things have continued to rise. We're now apparently, according to Case Shiller, right back where we were at the peak of the prices just before the downturn. So I think it'd be interesting to take a look at what consumer sentiment is, right? That's how confident people feel going forward. Now, the current economic conditions index increased to 112.5 in January, the highest level since 2004. Now, that's the economic conditions index. But the consumer sentiment index decreased to 98.1 from 98. To 98.1, down 0.1%. From December, but still up 6.6% from 92 in January of 2016. So we saw a bit of a bump right after the election, and we're still up from a year ago. It's going to be interesting to see what happens with consumer confidence given what we see happening with prices. Do the prices affect folks' confidence in the marketplace? And another thing to keep in mind is, if you remember, we talked about debt a couple of shows ago. And even though household income went up by, 0.3, household spending went up by 0.5. So that shows confidence as well, right? People are saving less and spending more, but it also does look like they're having to spend more on the essentials like gas and food, which leaves me wondering if that's really an exercise in confidence or necessity. So we'll have to see. The numbers indicate we're seeing a slightly higher level of confidence. That could play into a more robust real estate market moving forward. If people are confident, if people feel like things are going well, then they might feel like it's the right time for them to make a move into real estate. But then faced with the reality of where prices are in so many areas, that may not be a situation that folks can really glom onto. So we're going to have to see. I know I wish I could give you more concrete estimations on where things are going to go. I still stand by my estimate. I don't see any numbers here that make me change my opinion that 2017 is likely to be a relatively flat year, or at least not a super growth year. It wouldn't surprise me if we see marginally less growth than we did in 2016. I think that just the confidence levels are interesting to me. It'll be interesting to see how these change as we move further and further into the new year. If they do continue to go down, that'll obviously be something that would affect the marketplace and would serve to convince me that we're likely to see more of a slowdown, or at least not as much of an increase in values this year as we saw last year. All right, now I'm going to take a quick break here for a second, but when we come back, we are going to take a look at a great little tool that will help you discover where your market sits in terms of the rest of the country. That they're calling it the Realtor.com Market Hotness Index, and it's got some pretty interesting data in terms of the top 10 areas. It'll fall into an interesting sort of category that we've talked about here before. But what's great about this is the versatility in terms of you being able to search on just about any area. So don't go away. We'll be right back to talk about that more.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We just covered a couple of interesting little tidbits of news, one relating to where home prices are on average, having reached the pre-crash heights. We also talked a little bit about consumer confidence. Interesting numbers there, up from last year, down from the last month after getting an election boost. And we'll see how things continue as we move through the first half of 2017 and see if we can't figure out how that might affect general robustness in the marketplace. But next, I wanted to hit a new tool from Realtor.com. I'm going to include a link to this in the show notes because I think this is a neat one. Tons and tons of data. Now, they've got their hotness index, and based on who seems to be ranking on this, it's clearly based on things that don't really tell you potentially areas that you're going to make the most money or any of those kinds of things. It seems to be based strictly on just looking at this, since so many areas I know are at the very tippy top of this list, and some areas that kind of surprise me. It seems to me that this would be about increase in price, time on market, those types of things. So it's an interesting list. I go ahead, we'll run down the top 10. And I think the very first thing that shocks me a little bit is just how much California dominates this top 10 list. If we were to make it a top 20 list, it's still even more dominated by California. But let's go ahead and run down it real quick. Now, as you go through this list looking for areas you're interested in, one thing I want to draw your attention to is an area called the Market Spotlight. Now, when you open this up, you'll see a map of the United States, and there will be a pull-down menu just below the map that is labeled Market Spotlight. And what's awesome about that is you're going to be able to go and select that area, and it's going to tell you what direction it's moving in the ranking. Is it heating up? Is it cooling down? How many spots up has it moved? And the reason why I think that's important is if we're trying to tell the future, look into the crystal ball a little bit about different communities, you're going to want to know where you stand in terms of potential payoff from a increasing market. So once you make that selection, you're going to see what its rank is. It's going to tell you how hot it is. It'll give you the hotness index. It'll give you also a trend going back several years, back to what looks like 2013, and then a rank change indicator that all should go a long way towards helping you shift your gaze potentially towards different communities that might represent a greater opportunity for you in investing. Now, you can also then check out things by state, by metro area, by county. So it's really pretty cool. It's giving you some abilities to drill down quite a bit. And I'm going to suggest that you find some time today or sometime perhaps over this weekend to review this and see what you can figure out about your market. Maybe you can find some interesting data about your county or surrounding counties that might help you discover some gems right in your own backyard. Now, let's go ahead and run down the top 10 and see what it has to say about these areas. Now, number 10 on our list is Yuba City, California. If we go ahead and do the Market Spotlight and go to Yuba City, there it is. Boom. Yuba City is categorized as very hot. It's in the top 10. Its rank is 93.98. But its trend in terms of hotness is really more of a recent thing. Its overall trend going back to 2013, it's relatively flat. It's actually a little bit lower than it was in 2013, but it is up 28 spots since the last time this index was run. According to this, Yuba City is ranked number 10 out of 300 in the country in the month of December. This is a very hot market that is heating up compared to last month and heating up compared to last year. Median days on market is 64, with inventory moving 0% faster than last year and 25 days faster than the U.S. overall. Listings in the area receive an average of 368 views per month on Realtor.com. And that's another thing. One reason why I like getting data from some of these Realtor.com reports is they include that. I think that is one piece of data that absolutely gives you a clue into what's coming in terms of a marketplace. Because what all the people who are viewing those properties are who? They are buyers. They are people who are looking to buy in these areas. So it's basically telegraphing to you a future buyer for an area. If you're shopping in an area, you're looking because you're interested in potentially buying a house there. So that if you see a dramatic increase in the number of folks viewing those listings, that should give you at least a little bit of a clue that you're probably going to see a little bit of an increased demand in that community to go along with that. Listings in the area receive an average of 368 views per month, which is 2.2 times higher than the U.S. average. Now, you can judge for yourself at on number 10 here. I'm not quite as sold on this one, just looking at the trend line that it's providing. Back in, let's see, May of 2013, the hotness score was 97.6. And the hotness score in December 1st, 2016 is 93.98. So the trend is actually down from 2013. You can judge for yourself. It's a little bit more volatile over the last couple of years in terms of ups and downs. And this is month-to-month data, but it sure was relatively in decline all the way up until right around 2015. Next, another one that we have talked about a lot, number 9 on our list, is Sacramento, Roseville, Arden, Arcade, California. So for those of you who are in the Rebel Underground, you're going to be able to see this corridor of communities that's being referred to because the subject area that we look at in that video is Sacramento. And I believe there's one section in there where I do zoom out and you can see all the way up to Roseville and Auburn, and you can sort of see all of those various areas that this is referring to. Interesting note, we're going to talk about other areas in terms of desirability on the upcoming shows this week. Tomorrow's show, I know, for instance, we're gonna have an interesting take on that. And Sacramento is a very interesting one, and it's one reason why I'm so focused on searching in Sacramento for an investment opportunity for myself. Next on the list, Columbus, Ohio, with a 95.15. And if we do Columbus, Ohio, we see, a trend that's more comforting. We can see that back in May of 2013, the hotness score was 77.93, currently stands at 95.15. The general trend overall, if you sort of average it out, is increasing, so I think that's a good thing. The month-to-month move it's up one spot. And that's been and if you look at the trend line, that kind of makes sense. If you look at year to year, from last year to now, it's moved up 12 spots. So that's an interesting potential area for interest. Next on our list is Stockton, Lodi, California, an area that I'm kind of surprised is seeing so much growth. But I think a lot of this plays off of communities that are now a little bit of a distance away from areas that were more popular. I think you see people going to areas where it's more reasonable to live there. But that's Stockton, Lodi, California, coming in at number 7 on the Realtor.com Market Hotness Index this year. Next, number 6, another one we've heard a lot about is the Denver, Aurora, Lakewood, Colorado area. They're coming in at 95.99 at number 6. Let's go ahead and call up their data and see what the trend is. Trend is ridiculously flat. It's actually down 2 spots from last month. It's up 1 spot from a year ago. But this is one of the flattest trend lines I've ever seen. If we go all the way back to May of 2013, they scored 96.823. This month, they scored 95.987. And I tell you, that is just nearly the flattest line I've ever seen on something like this. And that's not something to be upset about. That indicates to me a consistent performer. That's one of these. If you don't see a whole lot of volatility, if you want to go with something that's just going to be a steady performer over a long period of time, the Denver, Aurora, Lakewood area could be a very big boom for you. However, if we were to plot this against prices people are paying, folks are definitely, or have been over the last year, paying a pretty high premium for properties. And that would be something that would concern me. You'd want to see that if you're seeing trends generally flat in terms of the hotness that's measured on this, and we've talked about that in terms of how long it takes things to sell, the level of interest people have in doing searches. You could count on a situation where if you're buying at a peak, you may get stuck there. It may be a situation where you cannot count on any sort of market increase because you may be at the top. In fact, you may even see a decrease in a situation like that where you've bought at a peak. But it looks like you could count on regular interest in terms of how interested people are in the marketplace. Let's go ahead and look at number 5, which is San Diego, Carlsbad, California, coming in at 96.32. Vallejo, Fairfield, California. And that one just stuns me as someone who has been to Vallejo. And if you remember, Vallejo was one of those cities that declared bankruptcy, if I'm not mistaken. In fact, back in May of 2008, they did in fact file for bankruptcy. And despite the fact that they've managed to recover, like other towns we've covered that we've talked about, like Dallas, Vallejo has a problem with pensions. This is a story from 2014. Once bankrupt, Vallejo still can't afford its pricey pensions. That could likely be a story that could cause an awful lot of trouble for the city. I was looking for some more recent info on that, and it sounds like that no real news has been made within the last year on that. But it's one of those things that I think is less to worry about in terms of specifically focusing on Vallejo, but it's just another one of those data points for us to keep in mind, because this is, again, it's not a Dallas problem. It's not a Texas problem. It's also a Vallejo problem, a California problem, and just about every other state has got these huge pension problems. And I'm going to include an interesting article from Bloomberg that kind of discusses the article's title is California Case Opens Door for Pension Benefit Reductions. And those could be a huge problem. So that would obviously hit the marketplace as well, simply because if folks have their pensions reduced, that reduces their cash flow, right? So I wanted to share that with you. Now, in addition, number 3, now we're finally stepping outside of California for a brief moment. Number 3 on our list is Dallas, Fort Worth, Arlington, Texas. Now let's go ahead and jump in and get more detail on that one. And it is showing it's down 1 spot from last month. It's up 1 spot from a year ago. And it's another one of those markets where everything is just flat. It looks almost exactly like Denver. In fact, despite the fact I said Denver looked more flat than I could imagine, Dallas looks even more flat. So that's kind of interesting. Now, this is showing, obviously, in rank number 3 out of 300 metros in the country. Very hot market that is cooling down slightly compared to last month and heating up compared to last year. Median days on market, there was 59 days. Inventory moving 2% faster than last year and 30 days faster than the U.S. overall. And listings in the area receive an average of 426 views per month, which is 2.6 times higher than the U.S. average. If you look at immigration or migration data, I guess, for within the United States, and that's something we talk about here from time to time, lots of folks move into Texas from California, from the East Coast as well. So they're getting an awful lot of folks moving in there, and that just increases demand for properties. Folks need a place to live, so smart investors can step in and fill that need. Now, number 2 on our list, my backyard, an area we talk about quite a bit simply because I have so much exposure to this market every day. San Jose, Sunnyvale, Santa Clara, California, number 2, rating 98.5. And it is, let's see what the trend numbers are for this area. A tiny bit more volatile, but still relatively flat. What's interesting is that the year-over-year rank is a 0 change. It's in exactly the same point in terms of hotness as it was a year ago. But from month to month, it is up 4 spots. They considered a hot market that's heating up compared to last month and heating up compared to last year. The median days on market is 49. Inventory moving 4% slower than last year and 40 days faster than the U.S. overall. Interesting things here that are hard to take into account for this is knowing that the one reason why things were moving slower last year, while inventory is moving slower than last year, is simply because inventory issues were playing into that primarily. It's, let's see, 4% slower than last year and 40 days faster than the U.S. overall. Listings in the area receive an average of 354 views per month on Realtor.com, which is 2.2 times higher than the U.S. average. Now, number 1, and this is yet another California community, San Francisco, Oakland, and Hayward. This one's interesting because it's also an example of something else we've talked about. Oakland is undergoing what everybody would pretty much define as gentrification. There are parts of Oakland that were very dicey, that are migrating their way into being gentrified as folks who simply gave up on finding a place to live in San Francisco ended up going over to Oakland, where in many neighborhoods, prices were a lot more reasonable. And this happened relatively fast. Some of the parts of Oakland that I've heard have changed. Now, I don't know, for those of you who haven't listened to the show for a long time, there was a period of time when I actually was an emergency medical technician. It's a long story. I was thinking about going back to medical school, so being an EMT, I thought would be a great exposure for that. So I actually did that for quite a few years and occasionally spent time in Oakland. And some areas that were very difficult to service in terms of folks who would shoot at vehicles that had lights on them are now gentrified and are absolutely rising in terms of desirability, price, all that kind of stuff. So it's easy to see how these trends have taken hold with this gentrification. And we're also, one of the shows we're going to do in the next couple of days is going to be focusing on the communities where gentrification is really happening in an aggressive way. Because what did we talk about in a past show relating to gentrification? If you want to look, if you can figure out where gentrification is going to go next, that's when you're going to be able to ride a wave of increase in value in property and desirability. So it's going to affect rents. It's going to affect resale prices. I don't consider gentrification really to be a bad thing. When you go to areas that have quote unquote been gentrified, they're usually pretty nice. I'm not real sure what the horrible thing is about it. But in terms of being an investor, if you can get in early on that process, you are going to reap rewards. You're going to be providing homes for folks that need them and being able to also benefit from taking the risk in terms of reaping some reward. So as I said, San Francisco, Oakland, Hayward is number one on our list. Let me go ahead and pull up what they're talking about in terms of trends. Now, this is very interesting. Again, another very flat trend line. They scored 99.33 in terms of their overall ranking, but 0 spot change. Well, of course, it's number one, right? So it's a 0 spot change from last year, 0 spot change from last month. So it's remained hot throughout the entire time. Let's see here. Median days on market is 50 days. Inventory moving 0% faster than last year and 39 days faster than the U.S. overall. Listings in the area receive an average of 390 views per month on Realtor.com. That number is actually a little lower than I would have guessed, which is 2.3 times higher than the U.S. average. Now, when we've looked at this data before, we've noted actually higher views or higher levels of interest. And I think a lot of that translates into folks who gave up and moved into other marketplaces. Now, what's also interesting is for the vast majority of these areas, these are not areas I'd suggest that you go and invest. I think it would be virtually impossible in some of these areas. I think Dallas is an exception. Parts of the Denver, Aurora, Lakewood, and let's see. So, and Sacramento, Yuba City. I don't know anything about Columbus, Stockton. I don't know if I'd do Stockton, but it might be a positive cash flow there. For these ones that are at the tippy top, there's not going to be positive cash flow there for you unless you can really, really find something that's going to work for you. And let me define what I mean by positive cash flow. Usually when the standard I'm using when I talk about positive cash flow is I'm referring to a situation where you finance 80% of the purchase of the property and you base your cash flow off of that. Now, for those folks who want to put more in, say 30%, 40%, whatever, that's fine. But just remember that negatively affects your return on investment number. You may get that return because you're financing less money, but then you have more money wrapped up in it, right? And it's about getting utility from your cash. So if you have $100,000 in something, you're going to want to see a return per year that matches what you think you could get in other things. So if you took $100,000 and invested it, had a history of investing it in the stock market, and you were able to get 8% reliably, well, you'd want to get more than that in real estate, right? You'd want to get more than what you could get doing other things. Now, granted, I don't know a lot of people who make that much in a lot of different investment strategies on an average level. I know some folks who've done great in the stock market, investing in startups and other types of things, but I also know folks who've lost their shirts. So you're definitely going to want to think of it as a utility proposition. What else could I do with this money to have it grow or have it contribute a return on investment, and just make sure you're engaging in a real estate practice that is the best level of utility for your cash. Now, hopefully this list will help you. I'm sharing with you the top 10, but because this is such a comprehensive list, because this goes so far through all of this stuff, I'm going to suggest that you jump in and take a look at this. You can check out your state, you can check out your county, you can get really into the nitty-gritty here. And check out any place that you like. And on my own time, I think I might just go check out Tennessee. Being a big fan of Chattanooga for whatever irrational reason, I'd love to see what numbers are there for that community. All right, folks. If I've done my job today, you have gotten more out of this show than the time you spent listening. And I hope that that's true for you. Thanks again for listening, everybody. I'll talk to y'all next time.